What is up? What is up? What is up? Hey, everybody. Hello and welcome to the CRE News Hour. It's a weekly podcast where we come to you live at 3 p.m. Eastern Standard Time to talk about everything commercial real estate and all the current events that are going on. My name is Henry Eisenstein. I'm here with my co-host, Rafael Collazo. How you doing, my friend?
Great, man. Can't complain. Just getting prepped. We have actually our first hearing for our rezone of a development project we're taking on here in Louisville tomorrow. So I took up a little bit of my morning to kind of get prepped for that. And yeah, it's exciting. Exciting times.
When's that coming up? When is that?
Tomorrow, we're on the docket for 1 p.m. We're seventh in line. We're seventh on the docket. So realistically, it'll probably be like 2:30 is when our case is going to be heard. But yeah, you just got to be there because you never know. Some cases go quick, some cases don't go quick. So just got to do what you got to do.
Wish you best of luck, my friend. It'll be fun.
Thanks. Yeah, I'll keep you guys all apprised about what's going on. But how about yourself, man?
Things are good. Just I was actually in New York, New Jersey this weekend for personal reasons and for business. So made a very quick trip back in Miami, and team's doing fantastic. We put 3 or 4 deals in contract in the last week or so. So just cruising along and trying to keep up with our hungry investors, trying to find them some good products. So I'm excited for today.
Awesome. Yeah. And I'm sure today we're going to cover some topics that are going to be pertinent to a lot of people, both investors and business owners and brokers alike. So let's go ahead and jump right into the dialogue. So, we've talked about this quite a bit on the podcast. It's probably pretty important, in particular in this environment, to be tracking how inflation is trending. That's kind of one of the big indicators that the Fed looks at to determine whether or not they're going to start modifying their restrictive stance on interest rates. And so it looks like there has been a slight increase in the month-over-month numbers for the CPI, and core inflation rose to 3.8% compared to just 4% increase over January. So, or 0.4%, I should say. Sorry. So doesn't really bode well in our eyes as far as whether or not they're actually going to start. The Fed is going to start reducing the restrictive policy. So there's a lot of people out there that are still optimistic that we could see some relief come, May/June. But, depending on what the next month or two looks like regarding the core inflation numbers, that may or may not be the case. I know that, they've already said that they're probably going to not start increasing rates again. But, again, it's just something to be tracking throughout the next several months because it's obviously going to impact the decisions that the Fed makes.
Yeah, so 2 things. Funny enough, I actually looked at my next article is also going to be talking about the same kind of thing. Talk about uptick in inflation. Obviously, there's a couple other things we'll talk about in that article. But what I thought was interesting that Barry Sterlick, the guy who owns Starwood Capital, was actually interviewed recently talking specifically about inflation. And he's like, listen, like inflation is I can't remember what the exact number that he said in delay, but it was like 6 months something or more in backlog, right? As in, like it's like when it comes to housing, like it's on a 6-month delay, right? Mm-hmm. So he's like, as per what numbers look like, 6 months ago, he's like, we're definitely headed towards we've been sub 2% inflation for the last 6 months or so. So it's like we're definitely moving in the right direction. It just really depends on the other metrics here, but very interesting article. I don't have the exact specifics right, but I would definitely listen to that video.
Yeah, and you're 100% right. I think I remember listening to that as well. Very eloquent individual, but he was talking about how I guess the rent numbers in particular are much more delayed than what you would typically see with
it could have been 12 months.
Yeah, he said 6 to 12 months, which again, rental rates have increased significantly over the last, call it year, but you own property and I own property, and it just seems to be that, especially in the residential space, there seems to be more options out there for people right now. So even if you're trying to attract a tenant to your apartment, it may behoove you to not be as aggressive when it comes to asking for certain rents, especially in different markets. And obviously this is, market specific, but I've definitely seen a dip off in the rental asking rates for certain bed bath counts in certain areas of town. And again, I can speak to the area of town where I own property. It's not quite the same as it was, just a year or two ago, where you list a property, an apartment for rent, and it's flying off the shelf. And you can kind of ask within reason, you can kind of ask for what you want. So I've definitely seen it on kind of real time in my end. So.
Yeah, and I was even speaking with a few people specifically around, these are large apartment owners, very, very large apartment owners, huge portfolios, thousands of units. And they're even talking about how, like, there's a lot of markets, even in the Sun Belt, very popular areas where rental market, the value, like the rental values are going down, right? And it's like, think about how crazy that is. I got two sides of a crazy, scary coin, which is like, one, your debt's going up, right? Like, because your debt cost is coming due, and then the interest rates are higher than probably when you bought it, almost for sure, right? And rental rates are coming down. It's like, that is a terribly scary play to be when both of those levers are moving in opposite directions. So just a lot of interesting things coming up, and especially with, like you were mentioning, the consumer spending, which I know it mentions it's here. Housing costs lead inflation uptick. So if you scroll down, it shows very, very similar, but this is just the annual inflation rate edges higher in February, basically talking about how, we're at I don't know what they're at, 3 whatever, 3.2, something like
3.8, 3.8 is what it says here.
Yeah, 3.8 for that's all items and food and energy and everything. And then the other one was
3.2.
3.2, yeah. So I mean, this just goes to show, and I really think that we're going to start seeing a tick down finally, because I believe this is so freaking backlogged that we're going to finally start seeing numbers in the right place starting in the next 90 days or so, because of all this. Because interest rates have ticked, they ticked back up again, right? Interest rates went from mid to high sixes for a period of time, and then all of a sudden they jump back up into sevens, right? So actually, let's see where's the 5-year Treasury at. 5-year Treasury rate. Where are we at? Treasury yield. What are we at? As of this here, it opened. This is actually fantastic. We opened very low. Wow, that's great. 4.144, which is fantastic. I mean, we were in the fives for quite a short period of time there. So that's actually fantastic news. So actually, we're in previous market day 3.6. This time last year was actually 3.68, which is kind of crazy to think about.
Wow.
So I do believe we're heading in the right direction, because just recently I think it was actually in the high fours, low fives. So this is great news. Let me see if I can go back a little bit ago. Hold on. Yeah, and then this actually talk about retail sales growth. Is finally going. In February we saw a tick up in 1%. After a negative number in January. This is just talking about debit cards and a lot of debt rising because everyone keeps spending a ton of freaking money. But let's see here. So okay, as of March, so it ticked down again to a low at 3.9. The Treasury was actually in the mid almost the mid fours, or the mid to low fours, like we were. Let's see here. Yeah, so we spiked up a little bit in like the last 30 days. The last 30 days we've had like a little bit of a tick up when it comes to interest rates. So this has definitely been affecting a lot of these types of deals recently, because the interest rates are in the mid to high sixes, if not low sevens. I just had a friend of mine who just refied on a big retail building, or they're in the middle of a refi, and they just got quoted 7.3. So
yeah, I mean, you're right. So
it's tough to make it.
It's tough to make it work, really. And I again, we kind of harp on this a lot, but I wish that we could be a little bit more forward looking, as far as not necessarily forward looking, but getting an understanding of what the total impact of decision making is, based on looking back at numbers. So I don't know. I think, especially we kind of referred to the Barry Stelrecht interview, and how he's been able to kind of identify that there's a gap in the understanding of the Fed oftentimes, where it says, okay, well, we're not factoring in, we're seeing up to date data per se with retail sales, but as far as housing and some of these other metrics, there's definitely a significant lag. And so I don't know. I think that what's going to come down to is that They're probably going to hold steady for a while. We may push through June and July and maybe even get into August before we see any type of restrictive modification of the restrictive policy they've taken. But until we start seeing some meaningful trending towards the 2%, which, like they said, they're just going to continue to follow that. And regarding retail spending, I mean, it is what it is. I'm shocked that it jumped that much in February. But hey, I guess people just spend as they want. So,
welcome to America. We like to spend money we don't have. The land of where we spend money we don't have.
Hey, yeah. I mean, it is what it is, man. I mean, if you're going to do that, then I guess you got to deal with the consequences once the piper needs to be paid. So, all right. So next up is more construction projects are being delayed or abandoned entirely. So as you're probably aware, if you guys are watching this, construction costs and labor costs and a variety of different factors are coming in all at once that are causing a lot of construction projects just to not be viable anymore. And so there's obviously metrics that they track. I think it's project stress index is what they referred to in this particular article. And, if you could probably go look it up, but the higher you go above 100, which is kind of the average, it indicates that there's a significant amount of stress on projects on average over the United States commercial real estate construction projects. So the drop off that is the most significant is perhaps most alarmingly, the number of abandoned public projects have jumped 70% compared to the same time in 2023, which again, I imagine a lot of these public projects, you may have signed the contract a year and a half ago. And, I'm not sure exactly what the fail safes are in these contracts to account for increases. But again, at a certain point, the construction company, it just doesn't make any sense anymore to be able to continue on. And ultimately it causes these projects to go be put on the wayside. And public projects drive a lot of construction activity, especially with the new, the plan that was instituted by Biden for the infrastructure bill. I mean, that's driven a lot of construction worker salaries and, demand for construction, which ultimately has caused a lot of increases in pricing for a lot of different things. And, I'd be interested to see what that's going to lead to as far as, how's that going to affect what, contractors or construction companies are able to charge per square foot. On the labor market side, that's likely going to affect the amount of people that can actually work in construction because there's just not as many projects that come available. So anyways, this article highlighted a variety of different metrics, including, projects that are being abandoned, bid activity, and the like. So,
yeah, I think this has been very interesting. I keep hearing this more and more where these larger companies that have all these different projects going on, they're pausing, right? They're pausing, walking away. They're putting it on hold till the next year. They're going to wait till interest rates drop because they're terrified of spending all this extra money on a project that all of a sudden is going to have major lease up issues, the continuing spending of all this extra money when they really don't know what's to come in the future, right? So definitely a very interesting world when it comes to development. I think that a lot of the smaller time guys it's so interesting, right? Like, at least this is just my 2 cents. The big players right now are pausing in a lot of different fashions, right? Like, they're slowing down. They're becoming a lot more risk adverse, right? And a lot of the small guys are getting way more risk intensive, right? Like, they're like, oh, let's go bigger, let's do this, right? Like, I have a guy who just did who's doing a 6-unit dev deal, is looking to get into a 50-unit and 100-unit dev deal right now. He's looking at this kind of stuff. And in all these different markets, like all these different types of construction are, depending on the projects, are either going crazy, explosive growth wise, are completely stopping and walking away, right? Because I have a friend also who's doing a lot of development work in Southern California and is absolutely crushing it, right? And looking to expand massively that way. So it's so interesting to see. Like, I would be really curious what types of projects they are and where that they're seeing major slowdowns. Because I'm hearing it too. I'm just curious as to what projects to stay away from most.
Yeah, I mean, the biggest drop off based on the article is public projects. So it's expanding roads, bridges, schools, jails, etc. So and that's a big driver for construction, the construction industry as a whole. So I would imagine that's going to lead us to have a slowdown in construction, and ultimately that'll help hopefully bring some of those costs down. Because I mean, if you're trying to do any type of development work right now, I mean, it is very tough to make the numbers work. So
Yeah, absolutely. Yeah, and
all
then
right.
this article goes into talking about the top 10 U.S. markets posted with the smallest declines of multifamily investment last year, because the year over year, U.S. apartment investment fell 63%, which is insane to think about. Because apartments, if we talked about apartments up until about 2 years ago, dude, right? You
Oh yeah.
tell me, tell me if
Yeah.
I'm BSing with you, but I mean, it was literally like every person, okay, every person. I was gonna say like no one would go 5 minutes without bringing up multifamily, but like literally every investor out there was like, hey, we're looking for large multifamilies. We want large multifamilies. Everybody was about buying as many large multifamily properties as you can get your hands on. And that has slowed down drastically. A lot of investment in the multifamily space has been put on pause because of the high interest rates and rent decreases. So super, super fascinating. I mean, this is saying despite the pullback, the Great Lakes multifamily sales outperform most U.S. peers. So obviously, based on certain locations, are doing much better than other locations. You can see here, like this is the top 10 areas: Milwaukee, San Jose, Orange County, Boston, Chicago, Indianapolis, Denver, San Diego, and Cleveland and Indianapolis. So these markets are cruising along. I mean, I have some friends who own a lot of stuff in Maryland. It's been blowing up. Columbus has been blowing up. A lot of places. I mean, the challenges is what's interesting is that you don't see Texas or Florida at all on there. Isn't that wild?
Mm-hmm. Yeah.
You know,
I mean, there's just so much. There was so much construction. I mean, you guys had so much housing stock being built, and these new projects they're probably still new ones coming online, right? That started in the past, and they're still probably working on trying to get it live. And it's only going to hurt the existing housing stock once those do go live, because those developers are probably going to have to lower their rents to start attracting new tenants, and it's just going to not necessarily depress the market, but it will definitely affect the market quite a bit. So
yeah, super crazy. I mean, like it's just wild to me to look at this, because if we were looking 2 years ago, it literally would be Texas and Florida as the top. Like every single market was, that are doing fantastic, Texas and Florida, and those are not even close to the top 10.
Absolutely, and really, I mean, like you said, how many times, I'm sure you got called all the time. I would get called a couple times a week from people who would be like, hey, like we're looking for, class B to C multifamily between 50 and 200 units, and all this stuff. And it was all generic stuff that people had heard on either, these investing platforms that, listen to Best Ever podcast or Bigger Pockets or something else. And then they think that, oh yeah, I'm going to go out and become a syndicator. And so you get like these people calling you, and I'm telling you, it was 2 to 3 times a week. I'm not even exaggerating. I would get these calls from people, and those have completely dropped off, or to a point where
most
now
of those people were major syndicators who are now majorly struggling to make those deals work.
Absolutely. All right. So next up is kind of a different property type, but obviously one that is very prevalent in the commercial real estate space, and that is net lease. So net lease could get relief under new tax bill. So this new tax bill is just kind of trying to re-implement the concept of bonus depreciation. And granted, I'm not an accountant, so I also don't want to advise you guys on tax advice. But this particular tax strategy was very valuable, because it enabled people to completely write off certain expenses for their property 100% in the first year, ultimately saving them quite a bit in taxes. So it kind of incentivized, primarily related to like capital expenses. That's what I did when I had to replace a roof on my fourplex, and I was able to kind of utilize the bonus depreciation to help accelerate the depreciation for that particular expenditure. So it helped me save quite a bit of money on taxes for that year based on the income that was produced by the property. So, again, that's what they're trying to do right now. The way the existing legislation is laid out is that it tapers off from 2022. So 2022 was the first year you would take 80% deduction. 2023 is 60%. 2024 will be, I guess, 20%, and then thereafter it's going to fall off. But the hope is that this new legislation is going to allow you to then essentially have the same thing happen, where you could go back to 100% bonus depreciation for certain capital expenditures for your real estate, which is going to be beneficial for investors. So anyways, that's
I mean, this is insane. I mean, the deductions aren't across the board. Land is not depreciable, obviously, but still, if the land value on a property is $1 million, is 20%, leaves $800,000. $1 million property is 20%, that leaves $800,000 for deduction. That's insanity. I mean, this is only for triple net lease properties.
I don't think it's only for, no, it does not only apply to triple net lease properties, but it's most beneficial in these instances where you're making these massive capital expenditures. So anyone can benefit from bonus depreciation. It doesn't,
Of course.
it doesn't restrict you only to net lease properties, but because you're making such a significant capital expenditure for oftentimes with these triple net investment properties, because usually they're ground up and you get them sold or whatever, if a developer kind of like builds them and then leases them and sells them. I think there lies an opportunity for a lot of these net lease investors to capitalize from a tax standpoint. So
yeah, I mean, it says if this goes into effect, this caters to a wider audience. Many business owners don't want to become landlords, so these passive triple net properties are attractive. So I mean, this would be fantastic. I mean, like, guys, I mean, because realistically, for cost segregation studies, you're realistically getting like what, 30%, 40%, 50%, accelerated depreciation on the property when you buy it, right? I mean, if you're able to get 100% of the property value, I mean, that is insanity, right?
Yeah. I don't know
gas
exactly.
stations.
I don't know. Yeah, I don't know. I don't know if it's exactly the 100% of the property value. That example was kind of odd, and that's why it's good to talk to an accountant, because I'm pretty sure it's based on the capital expenditures. Now, if the capital expenditure is you developing the property fully and all that is baked into the capital expenditure, then maybe that's what falls under the tax law. But I don't 100% know. But
yeah,
it is
obviously this is a point.
It's a significant tax savings.
Yeah,
it's a significant tax saving. So, anyways,
yeah, super interesting. I'm gonna have to give my accountant a call and see how we can make that work.
Dude, yeah, you should be talking to your accountant all the time, because you never know what's gonna. And not just you. I'm saying in general. You guys are listening. It's important to have conversations with your accountants on a regular basis to kind of get an understanding of how tax laws are changing and how you could benefit from these new opportunities. Oh, I love these graphics.
Yeah, I know, this is a pretty cool graphic, right? So this is talking about where, most of the money is being invested, like the top areas around the world where money is being invested. What's fascinating is obviously you see the red is the US, blue is Europe, and green is Asia Pacific. So what's fascinating here is that, like, if you look at the top 10 markets, all of it's really, I mean, like a vast majority of the top 10 markets are the US. And if you pause here at the end here, in 2023, because it'll once that marker goes, but like 4 or 5, there's a pause button on the left. So if you
I'll go all the way to the end here.
Yeah, so
man.
Oh
shit, no, it's fine.
You're good.
There we go.
So there you go. So the top, what is it? Top 4, top 5. There you go. So top 5, 4 of the top 5 is all of the US, or of the United States. So Los Angeles has had the largest direct real estate investment volumes. Los Angeles, which is fantastic. I mean, which is freaking weird. I'm not going to say fantastic. It's freaking weird, because I honestly don't understand why California is getting so much investment right now, honestly, based on legislation that I just don't get it. Shocked by that one. Dallas, not shocked whatsoever. And if you actually look a little bit farther down, you see Houston is not super distant, but actually shockingly a lot farther down the map here than I actually would have expected. But this is all over the globe, people. This is the global top 15 for the quarter of Q3 of 2023. That is fascinating to me, where all this money is being invested, right? How much money is being invested in these types of markets where transaction volume, this is saying this is a transaction volumes or deals size with $5 million or above, right? So Los Angeles had 96,000 transactions at $5 million plus. Dallas had 91,000 properties at $5 million plus. New York, obviously, 80,000 sales of $5 million and above. London had a bunch. Atlanta, Phoenix. I mean, this is freaking insanity. How many, like, all these are the markets that, like, if you guys are looking for investments, this is what being in, like, what all the private equity groups are investing money in. These are the locations that they're looking to put money in, which means we should be putting our money there too.
Yeah, and interestingly enough, there's only one city in China that made the list, which was Shanghai. Beijing and Zhengzhou and all these other larger metro areas. Obviously, if you've been following, they've been going through a period of significant, not so recession, but not a country recession, but they've had a real estate crisis in the country over the last several years, and that's greatly affected their ability to, perform in a lot of these ways. But it's great. And obviously our property laws in the United States are really, owner friendly, which is great, and obviously that's why you get a lot of people investing in property from other countries in the United States for that exact reason. So, I'm just glad we have the opportunity to be here and capitalize on these opportunities that are presented to us because we live in the country. So,
yeah, and what's also interesting though is that actually with those areas, pay attention to those areas, because if you have a real estate license, and I'm not here just to pick on you in Kentucky, but I'm saying like a lot of people like to increase your average price points, pay attention to where you're selling properties, right? Like if you're seeing that a ton of sales are occurring in these areas, you have not gotten your license yet. You're like, where should I go get my license? Maybe I'll move. Maybe you can go focus on these markets where there's so much money being invested in these areas. Like if you were licensed in, in the random area of Oklahoma, right, or South Dakota, versus being in a licensed Texas and go properties in Dallas, you have a much larger capacity of sale, right? Both in price points and in volume, right? So just keep that in mind when you're getting your license, because it's like, okay, well, if I'm going to get licensed and I can choose to get licensed anywhere and go live anywhere to go sell real estate, why would I not focus on these areas that are exploding?
Absolutely. Yeah. And obviously if you're dealing in the net lease market, you can transact pretty much anywhere. I know I've done deals in markets that I don't necessarily have a license in. I just hang my license with the broker of record and pay a small fee, and then you can transact. So depending on the property you decide to go with, that's 100% right, Henry. So next up is cap rates may have hit their high point. So this article kind of highlighted, similar to what we've been describing before, they've been tracking treasury bond yields, and oftentimes with investors, when you're trying to explain to them, okay, well, why should you be investing in real estate? This is usually one of the first things that they'll often say. They'll say, okay, well, if I can buy a treasury at 4.25%, why would I take a 6% or 7% return on real estate? And that's a very valid point. And that's obviously why a lot of deals have been not being able to get done, because the expectations on the seller side have been delayed based on what they've seen over the last couple of years. But in reality, this new environment doesn't support what their expectations are. And so, they through this tracking, they've seen average cap rates through the end of 2023 rose from 6.4% all the way up to 7% for different property types. And going into Q1 of this year, they're starting to see a dip off now back down below the 7%. So they're projecting that cap rates as a national trend, because again, we always talk about focusing on your locality because it may be different in your market, but as a national trend, you're starting to see cap rates begin to compress a little bit. So obviously that bodes well, hopefully, for people who are representing sellers, or if you're trying to sell a property that falls in line with this type, like it's an investment property, it's hopefully going to mean that you get some relief on the pricing side. So yeah.
So this is so interesting. So this is saying that they actually, this is almost a 10% increase in cap rates. Percentage point wise, right?
Yeah. It was significant.
That is wild. That is absolutely wild. This is what period of time? I'm just curious. So this is saying from 20.
I think it's throughout 23. So from January all the way to call it the end of 23.
The end of 23. Got it.
That was the time period they reviewed.
Yeah. So, okay. Got it. Yeah. This is wonderful, guys. Guys, this is where a lot of the money's made, right? Is being in the ability to negotiate deals and enhance your returns, right? That's where money is made, is saying like, hey, I'm going into a deal, and how do I negotiate strategically where I can get a better return for my investors and or myself, right? If for the buyer, right? How do I go in and structure the best deal possible? Now, obviously, if you're trying to work on the seller side, how do you present the property in a way in which you can sell buyers on the idea, right, on the process, the clear pathway to higher profits, higher returns on this property? That is your job as the broker. How can I show you a very clear path to getting great returns with this property? If you were to purchase it here and you operate it to this extent and this occurs, these are the types of returns you can achieve, and here's a clear path to doing so. Because what happens is all these sellers get these crazy starry-eyed ideas because random brokers call them out of the blue, or random investors call them out of the blue, who have absolutely no idea how to evaluate properties, and they make random offers on the properties that are way too high, right? And then all of a sudden, you ever get a seller, Raphael, where they're like, "Oh yeah, well, I was offered $5 million for this property. I want $5 million, right?" And then it's really worth 4 or 3.5, right? It's like, yeah, when'd you get that offer? Oh, I got that offer 3 years ago during 2021 when interest rates were 2.5%. Oh, fascinating, right?
Mm-hmm.
So it's just like really being cognizant about being able to, structure fantastic deals for your investors. And I love seeing this type of stuff. I can't wait for cap rates to continuously increase. That means better and better deals for our investors and for ourselves.
Yeah, and again, we're educators on either side, right? So as a buyer, if I'm trying to buy a property, I have to educate the person that I'm trying to buy the property for, I'm trying to buy the property from, how the landscape is what it is and why we're offering what we're offering. So educating yourself about where the 10-year treasuries are, that's obviously the alternative to buying a piece of real estate. Talking about different interest rates, where the interest rate environment's at, what comparable properties in the area are actually trading at. These are all the tools in your tool belt that you need to use to craft that story, as Henry said. So, again, I think it's just important, kind of as what you've described, to, always be up to date on things that are happening around you.
Yeah, absolutely. So, next article up is going to be one of mine here, which is structuring leasebacks, right? So this is just talking about how the Dish Network was actually just recently sold to a company called EchoStar. This was in like a huge $26 billion deal recently. So the Dish Network, again, so if you have Dish, but whatever, you might see it a little bit differently. It's a satellite television company, which I don't even understand how on planet Earth Dish just sold for $26 billion. I don't know what the heck they're going to turn it into, but who knows what's going to happen with that. The point is, Dish is selling a lot of their properties and doing a lease back. You can see as part of the deal, Dish will lease back the property for an initial 10-year term with rents that start at $228,500 per month, and that rate will increase by 2% per year. I'm curious to actually see what they bought the property for. Oh, lease back agreement. Here you go. $26.75 million. Now, ready for this? Mm-hmm. Let's figure out what the cap rate was. I guarantee you this is obviously probably a triple net deal. I'd imagine, but it does not say if it was triple net or not. But let's see what this is, right? 228,500, right? I'm just going to take that number times 12 is $2,742,000 divided into 26,075,000. That means you're getting a 10% cap rate. Do you like that? Mm-hmm. 10.25 cap. Right. That is amazing. Great job to structure this. EchoStar got a fantastic deal. But this is what I've been doing, by the way. There's a huge opportunity in leasebacks. I've been doing a lot of these leasebacks deal structures with a lot of owner operators of properties, where you can get somebody to give you, and because they can afford payments of X, and you can try to structure a 9, 10, 11, 12 cap with ease on a lot of these deals. So anyways, this is just a great job by EchoStar structuring this deal. Nice job here. But EchoStar bought the property off of Connex for $26.75. I mean, what a great job. And these types of leaseback deals are awesome for brokers to structure. I think everyone should be looking into ways where you can structure these types of deals to get your investors some great returns.
Absolutely. Yeah, no, I couldn't agree more. And like you've talked about many, many times, it is a very powerful strategy to kind of advise people on, because again, it allows them to unlock capital in the building that they can use then to go and do what they need to do in their business. And ultimately, that's the way you pitch it. And, if they value that, then obviously they're going to take you up on it. And hopefully it makes a win-win situation for everyone.
A lot of the time they're like, hey, it's just a cash injection. You don't stop, you continue business as normal, right? Yep. And it's not like they're normally paying money anyways for a mortgage payment with taxes, insurance, no matter what. Right.
Absolutely. So, and they can write off the lease, and they can light off the lease rate. So there's tax benefits to it as well, which is great. So, absolutely. All right. So final article: more workers piled into offices in February with visits up almost 19%. So this is obviously a good sign, I think, for the broader work environment as a whole. But if you follow Placer AI, it's that platform I had showed you the other day for kind of track geofencing properties and tracking cell phone data. So they were looking at different office buildings and track foot traffic for, it says here, 1,000 office buildings across the country. And although office building visits were still down significantly from February of 2022, the gap narrowed quite significantly. And in particular, in markets like Miami and New York, where there are finance-heavy businesses on site, they become the leaders in return to work. So it looks like Miami actually is probably the number one in that they have just a 9% drop off compared to February of 2020, up 23% year over year. And New York office traffic was just down 14.5% compared to 2020, up almost 22% year over year. There's also a lot of larger firms that are requiring their employees to start coming back to the office. I think we all agree, for many industries, that being around and being in an office and a collaborative environment, you just seem to be more productive. And so hopefully more and more leaders are going to realize that it's probably the way to handle it. And although we may not go back to a full 5-day work week in the office, having some flexibility, maybe a 3 to 4 day work week in the office, is probably the way we're going to eventually settle in. And who knows how long that's going to take to manifest, but it's most likely going to be what ends up happening. So.
Yeah, this is actually super fascinating. I mean, like I was actually just talking with a guy. We were talking about how a bunch of the big investment owner, the big office owners, like the guys who own a bunch of office buildings in Manhattan, have been were for a period of time, obviously for many years, we're in such a fantastic place, and then through COVID, they kind of got really, really, really hurt. They were originally hurt in 2008, and now they just got absolutely, just decimated in 2020. And now they're really, really struggling with interest rates coming back up. And they're kind of seeing like the major vacancy, which is triggering these events around refinancing and the fact that, or their capital calls, so they can't, these banks are asking for more and more money. They don't have the money, and they're not going to keep putting money into a building where they're losing money on. So they're just walking away from these huge office towers in Manhattan. So I just think it's interesting when you see articles like that, because, in real life, at least just from my personal experiences, I haven't seen anybody doing well in the office sector personally in Manhattan. So I'm curious to see who those people actually are.
Yeah, it seems like, based on a lot of the people that I've talked to in the office space, it seems like if you're building something brand new and really nice, and it's a Class A product, you tend to do okay. I mean, and especially in these markets where there is still a strong demand for workers to come into the office. So I'd imagine in Miami, if you're probably building a brand new, beautiful office building kind of near the water, I'm sure that thing's probably going to do decently well. We track data in a couple previous articles that kind of showcase that exact trend. So it's probably the people, again, I think it's more so the existing product that is old and maybe not quite as amenitized as some of these other buildings that's going to be struggling. But I mean, if someone were to approach, a larger entity, and they said they wanted to take on a large office development that's going to be like really nice in a particular market, it could still very well be a very attractive opportunity. It's just, it's just a different thing. I wouldn't touch it, but
Yeah,
I'm
I
sure
mean, Miami's a really
would.
fun. I wouldn't touch it either, but like Miami's a really funny market where there's so many people who have office spaces all over, and like nobody shows up on Fridays. People leave early. It's just like the strangest working environment that I've ever experienced. Like working hard here is not shown. I'm sure in Manhattan it's very much so, but in Miami, it's the opposite. So I don't know how anybody makes any money out here at all.
Interesting. Well, cool, man. It's good to have all these people. If you guys are watching this, obviously we appreciate you checking in. Kenny, thanks again for checking in and stopping by. Appreciate you commenting. And again, I know Henry and I have talked about this on several previous episodes. We're going to try to see if we can also incorporate some people to come on the show to kind of add to additional banter as we review some of these articles. We think it'd be kind of nice to get additional perspective from people from all across the country, and really brokers and content creators that are doing these exact transactions. I mean, Henry and I always talk about active deals we're working on, try to provide some perspective, but it's also good to kind of get other people's perspective from other parts of the country as well. So we're going to try to see if we can incorporate some people coming on the show and just providing additional insight. If you guys have any recommendations of people that you'd like to see on the show, again, let us know. We already kind of have a short list, but we'd like to continue to add to that list if possible.
Yeah, so yeah, definitely take we're be excited, because over the next couple episodes we're going to be trying to get between 1 and 2 guests on each week to be sharing their insights. So excited to see how that pans out. I definitely think it'll be super fun to have more of us on here. And then thanks again for tuning in, guys. This is gonna, we're gonna wrap this up for this episode. We appreciate it very much. Thank you for always following us. We'll see you guys next Wednesday at 3 p.m. Eastern Standard Time with more articles.
See you guys.
Take care, everybody.